how does this impact us? Let's go now to our guest line and talk to Professor Ken Rogoff. He is a Thomas D. Cabot Professor of Public Policy and a Professor of Economics at Harvard University. Professor Rogoff has served as an economist at the IMF and also on the Board of Governors of the Federal Reserve System. He has published extensively on policy issues in international finance, international debt issues, and international monetary policy. His most recent book, This Time is Different, 8 Centuries of Financial Folly, of which he is co-author with Carmen Reinhardt, was released last month. Professor Rogoff, welcome to Marketwrap.
Thank you.
Let's talk a little bit about the financial crises. These have happened regularly. And an article that I read that Professor Reinhardt had written, and she said something very interesting, that we might be speaking Japanese and we might not even know it. Are we in financial trouble, or is everything fixed and is everything wonderful again?
Carmen and I have been working together for 7 or 8 years, and we have certain creative tensions, so I don't think things are quite as bad on the Japan front as she does. Basically, I think Carmen's point is that if you look at what we did to our banks, we didn't really fix them. We just guaranteed everything. We didn't clean up their balance sheets. We just moved it onto the taxpayer's account. And that's what Japan did. We didn't do what Sweden did or Norway did in cleaning up quickly and getting on with things. And it makes us vulnerable. It makes our banking system look good, but not necessarily going to be strong for lending to the economy, and could keep us weak for a long time.
So you think we've got these zombie banks now, like they did in Japan, where they had these banks, they did not really realize the losses, and they continued for a period of time, and they've muddled for the last 17 years. Are we in the same kind of situation, or do you think we are much better off? I mean, look at the stock market. The equity markets come back up, and we're seeing the real estate market stabilize and also start going up. So why this concern?
First of all, the equity markets bouncing back is just par for the course. It doesn't mean the economy is going to bounce back. And as far as real estate markets bouncing back, especially in the United States, that's very artificial. They're propped up by myriad subsidies, which, due to our own soaring budget deficit, we're not going to be able to hang on to forever. I mean, I think our economy is, certainly healing, but it's still vulnerable for a long time. I mean, that's what happened with Japan. I think we'll experience a Japan light, growth slow enough to make it difficult, for example, for the government to balance its books. Tax revenues will not go up as quickly as they forecast.
Professor Rogoff, what's wrong with that? We can just we've sold all of this paper to all the foreigners. The largest holders of our debt are the Chinese and the Japanese. We can just inflate that away, and everything is fixed.
Well, we can inflate it away eventually, but it's very painful because it means not only we're inflating away the debt we gave to them, we're inflating away everything inside the United States. We lived through that in the 70s. It's no fun. It would be a lot better if we just figure out a way to put our government budget on a stable and sustainable course. But, for the moment, there's very little political will to do that. We see just the opposite direction. We're talking about taxes probably needing to go up 30% overall in the next, 5 years in order to get on a sustainable trajectory, or slashing expenditures, an incredible amount.
Professor, you just said taxes have got to go up by about 30%?
Well, the federal tax take right now is about 15% of income. Historically, it's been over 20%. We're running these giant deficits in no small part because of that. Mm-hmm. And it's probably at least got to go back up to what it was. That would be, going from 15 to 20%, adding a third to the tax take. And that might even need to go up more because we've got to pay off these debts. Now, I'm not saying everyone's taxes will go up 30%, but I think it's just a fallacy to think we can get away with just taxing the richest Americans, and that's going to balance the books. Unfortunately, that is not enough. It might be the right place to start. It might be important for legitimacy of the later tax hikes, but I think we're going to find we need to do more than that.
Let's talk a little bit about unemployment, and you built a really interesting model in this article. It shows that unemployment, which hit 10.2% last Friday, it goes up an average of about 7% in these crises, in a garden variety financial crisis. If you add 7%, we are looking at somewhere around 11% unemployment in the
Well,
U.S.?
that was the projection that Reinhardt and I published some while back before the crisis really, it had hit its full fury. That's the history of deep financial crises, 7% unemployment. In many ways, it's a bit worse than that already in the United States because a lot of people just withdrawn from the labor force. They've pulled out. The participation rate, the number of people working, has gone down 3%. If you add that to the unemployment rate, we're really at 13.
Professor Rogoff, somebody driving along right now that's tuned in Los Angeles, in Phoenix, in Las Vegas, in San Francisco. What should the average person be doing? Should they be thinking about Christmas and spending like they have in the past? Or should they be more worried about increasing the savings rate and reducing their debt right now? What should the average person out there be doing right now?
Well, it's very tough for a lot of people because the employment market's so tough. And, increasing their savings, not an option for a lot of people because the times are very tough. I think those people that, are in a position to do so,